the topic that we were given by the organizers is very interesting. Picking apart a diverse region, and are we comparing apples to oranges? I'm sure all of us seated here will know that ASEAN is not a single market. It is 10 different countries. So we were having a discussion before this, right? It's 10 different countries, 10 different regulations, 10 different people, cultures, languages. And it's such an interesting market to be looking at because it's so fast growing as well. So before we dive into the questions, may I please invite my panel to introduce themselves, maybe starting from Karam.
Hi, I'm Karam Butalia. I'm with KV Asia Capital. We focus on Southeast Asia, mid-market, predominantly buyouts. We look for quality, growth, and value, very traditional. And we are into our second fund now.
Hi, Josephine Price. I'm with Anthem Asia. We're very niche. We're doing SME ventures in Myanmar with a focus on women-led businesses. But I've been in Asia since 1983, was running some Pan-Asian funds. So I'm familiar with the region and with the way it's been developing for that period.
Hi, Eric Marchand. I'm the head of the APAC program for private equity at Unigestion. We are a Swiss asset manager with 25 billion under management and 8 billion dedicated to private equity. So I am based in Southeast Asian region. As such, cover that sub-region as well. And we have a number of relationships in the region. So hopefully be able to bring a more LP view to the conversation.
Excellent. And last but not least, I'm Ifai from Preqin. I head up our Asia operations. I mainly focus on managing the research team and coming up with our research strategy to cover all of APAC most effectively. I'm based in Singapore, and we have a 60 people team across Singapore and Hong Kong looking after all of APAC. And we also have some outsourced researchers in places like Manila, Guangzhou, and India. And we are more than 300 strong all across the world in terms of the research that we do. Now, without further ado, may I ask the two GPs here, right, to talk a bit more about your investment strategy for ASEAN. As we know, it's 10 different markets. So what do you focus on? Let's compare and contrast strategies or countries if that's possible. Perhaps, Josephine, you want to take us away?
Okay, so I'm going to start with the usual view of Southeast Asia is you look at population, you look at GDP growth, you look at natural resources, you look at access, and then you look at the market generally in terms of, is it a beneficiary of the demographic dividend? What's its laws like? So the usual screen that you apply to any country and its attractiveness, you apply to the different countries in Southeast Asia. And across that, there are countries like Indonesia have got big population and the demographic dividend. In terms of Myanmar, it's got a demographic dividend, it's got a large land mass, it's got access to clean water. And then across the typical screens that you use, you would also add the more complicated ones, and that's my sort of thing that I'm boring everyone with at the moment, which is history and politics. Because the history and politics of each of these countries, I think, now that we're in a world where political risk is one of the biggest risks going forward, will play a much more significant role in the analysis and understanding of these markets. We've had 20 years of Goldilocks, where everything was good, or not good, but at least not as bad as it was before. But let's just remember what this region was like. All of the smaller wars, all of the conflicts, all of the pent-up problems that are latent. Now, Myanmar is suffering with one of those because it's got a problem that hasn't been fixed and it's delaying its development. But there are other problems across the region. So I think globally, we are all opening our history books to remember what happened, and we're looking at geography books to see whether we can get oil tankers through different regions. So what I would like people to take away from this would be we have to apply the standard economic understandings, the standard screen in terms of ease of doing business, availability of good taxes and regimes, but we need to also add for Southeast Asia going forward, or rather, let's look back. Let's look at history, let's look at geography, and then we have to take a giant leap forward because things like AI and what's happening in digital mean that we need to remember that there can be changes that are going to happen in this market that we haven't really seen before. So life is just a bit more complicated. It's much harder to make harder to just say, oh, I'll go there because the population is this, it's got this, this, and this. There may be some other problems there that we need to be reminded of.
Thanks, Josephine.
Yeah, I think on KV Asia's side, we kind of look at it a little very simply in terms of three aspects of it. You know, our purpose is to make dollar returns, and so that's the core of what we're trying to do within a certain time horizon. And so that really leads to three key points. The first being that returns are a function of risk reward. So we focused on risk reward, whether it's macro risk, micro risk, cultural risk, all these risks will come into that risk reward aspect of it. That's the final analysis. Yeah? And we're in the business of taking risk, and you don't make the kind of returns LPs want without taking those risks. Yeah? The two key aspects, I guess, about us, which might be different from others, is we firmly believe the way to make money is really focus on the right people. Whether you have a buyout or you have the right a minority, it's about people. And good managers can fix a bad business. Bad managers can mess up a good business. So we are constantly looking for the right people to align ourselves with and work with, whether it's 100% ownership or it's a 26% ownership. As long as the meeting of minds and there are competent people with the right character, integrity, and other aspects, we have a full analytical process behind that. So people aspect becomes very critical for us. Yeah. And the business. So while we do look at the macro side of it, what's wonderful we find is, we looked at 900 deals, done 7. The real difference comes at the once you disaggregate it down to the micro, the business level. And we have certain criteria where we look at all the sectors, business model managements, the whole thing, size, scale, and everything on it. Yeah. So our strategy is really about picking the right people, the right businesses, a fair risk-reward balance. We don't go too small, minimum EBITDA, normally about $10 million, and try and, from the moment of making the investment, spending the money, driving that change to the point of exit, and hopefully making money and distributing it. So it's a very simple approach to it. Yeah.
Thanks, Karam. And Eric, from the LP perspective, what is your investment strategy in ASEAN?
I think I'm going to try to take a more global view of a specific region. I think what I hear a lot when we're looking at investments, and that'll apply to South Asia and Southeast Asia, is when we're looking at investments, is the quote unquote, the bar is higher in those regions for us to execute an investment. And I take issue to that view because it's the bar is higher versus what? Versus the EU investments and versus North American investments. And my argument internally, which hasn't swayed that many people yet, is that the bar is different, right? You are going to target, because you are going to target a certain level of returns that are frankly, if you look at the track record in the region, are be commensurate to what you can get in the US or Europe. If you slap on 75% of debt, that's your value creation plan in developed markets. So my argument to them is, well, what you're doing is that you're shifting the paradigm, is that you're taking another set of risk. In developed markets, you're taking a level of risk that is very inherently linked to financial engineering. So how do you get 20+% IRR returns is by putting a maximum of debt on your business, typical buyouts. Whereas in places like Southeast Asia, what you're actually going to do is that you are securing a level of growth in the business that's can challenge a bit, the magnitude, but you know that you're going to go on a growth path, and you're just taking a whole other set of risks, which are governance, which are geopolitical, et cetera, et cetera. So you end up with a very similar return potentially than developed markets, with a little bit more volatility, obviously. But overall, if you do your job well, you get to similar returns. However, it's not synchronized with what you would have in developed markets. And I think that's, for us, the attraction of Southeast Asia, is that if there is an economic downturn, yes, the entire globe is going to be affected, but the secular dynamics within the region won't change. You will have secular growth in Vietnam, Myanmar, Indonesia, and all the other countries around. It's a pretty secure region in terms of growth, and in a environment where people are all saying there'll be a crisis on the horizon, from a growth perspective, I feel Southeast Asia is relatively safe.
Just to come back to Karam, when you said risk-reward profile is important, right? Do you see a spectrum of risk-reward across Southeast Asia? And for KV Asia, what would be the sort of optimal risk-reward split?
The optimal risk-reward is naturally on a risk-free if you get 25% dollar returns plus, right? But you don't see that kind of thing, right? So look, my perspective is perhaps a little different, because I was running the private equity business for Standard Chartered Bank till 2008. So I have invested in India and China and other parts of the world, and previously also in Australia and other things. So, and I have seen many cycles in this game since about 93 onwards. So whether it was the 97 crisis in Asia, or I was right in the middle of it, or the SARS, or 08 and all this stuff. So crises come and go, but one should never miss a good opportunity to make money on it. Yeah. I think from the point of view, like I said, we found the sweet spot. First is, we focused on Southeast Asia because, as Eric rightly pointed out, we think the risk-reward equation here is quite exceptional. And I think the Fund 1 numbers seem to be bearing that out. We see opportunities to do buyouts of a nature where it would be very difficult to do that profile of buyout in most other markets. And I think I'll talk about one such, but the key is risk is not a function of only the macro, it's the underlying asset you buy. Let's say we bought an education company which had about 13,000 students, 11,000 in the tertiary, it's 42% market share in the IT computer science, and about 2,000 in K-12. And it has grown EBITDA in about 18 months to, I would say, about 50+%. We sold off the K-12 business and returned half the capital. There are value creation opportunities there, whether through the dormitories or growing colleges and other parts, of being able to clearly return at least 3.1 times capital. In an education sector, we bought it at 9.7 times EBITDA. I mean, it's below 10 times for a size and scale of that nature. Where can you buy an education company of that nature? So when people talk about risk at a macro level, I think they're missing something, because the underlying risk always depends on the underlying company, and you can't take away the people, the managers from it. Whether I own 100% of a company or I don't, one manager can make it a very high risk deal, another manager can make it a very low risk deal. So that's why I focus on the people, the business, and the risk reward equation on the macro side. The risk inputs come, and yes, if there's dollar volatility, it's an input on risk. But you can always factor that into your model of maybe there's a 3-4% per annum depreciation in the currency. If the reward is good enough, it makes up for it. So for us, risk reward is the funnel, the catch-all, and does it lead to that gold mine or not? And we find some great opportunities in Southeast Asia.
Thanks, Karam. And Josephine, you are in it's as niche as it can possibly get, isn't it? SME ventures and women-led firms. So for you, how do you see the risk-reward profile? Is that even a consideration for Anthem Asia?
Absolutely. I mean, I'm doing it because I would believe it's a great place to be. So having seen China investing in China in the 90s, and having gone into India and other markets, it's tough, but it's good to be in early. So yes, absolutely. We're there in Myanmar because we think it's a great market to be in. We think it's got everything it needs to make a market work. And my references on risk is just that it was seen as very risky, and now I think everyone's seen as very risky, so it's sort of evening up. It's got water. Let's just look at the problems with water. It's got great access to different markets in terms of transportation. So when I look at what has happened, and later stage, everyone's going to do buyout and everything, but if you like growth, which is what I've been doing for more than 20 years, it's a great place to do growth. And I also think that because the market now, SMEs are what made countries like China and Vietnam, they became the big businesses in China and Vietnam. So in the SME sector, because the businesses there are the really interesting one. They've got great people, they're smart, they may be small, but they can grow, and they have much less baggage than the large crony-related companies who, if you go in to see them, are not interested in governance, they're not interested in financial reporting because they've made so much money in other ways that the message is not getting through. But if you're talking to SMEs who are growing businesses in an expanding market, then you can work with them. You can look at where the dollars are going. So yes, you're there because it's SMEs, it's a great country. And also, it's now fashionable to say women-led businesses have always done it. It's nothing new. But in Myanmar, you've got some very smart women running businesses, and I happen to believe that because it's a little bit tougher for women, just a tad tougher, that the ones who come through have just got that much more resilience that they're great to back.
Things a lot tougher.
Can I just add one more thing before you push it on? The one thing I do want to emphasize over here is when Josephine talks about growth, and when we talk about buyout in Southeast Asia, it's still growth. Buyout in, I think Eric or somebody mentioned earlier that in the West, in the OECD markets, you look at a buyout as mature business and put on debt and financial engineering, you make money. But in our parts of the world, with a buyout, you still want to grow it because the underlying markets are still growing. Yeah? So hence we look at quality assets for growth at value, and that value is the risk-reward part of it.
Thanks, Karam. Yes, that was Eric who said, you guys look at investments as, in Southeast Asia, as maturing and developing, isn't it? Could you tell us a bit more about that, please?
Well, I think it goes back to the theme of this panel. Is simply put, you're in a region where you've got one country where the GDP per capita is north of 50,000, and then you've got at the lower end, I don't know what Myanmar is, it's one of the lowest. 1,500. So that is really the magnitude of the difference. And I think the way we look at, so obviously from a mature side, Singapore is the odd one out within the region. You've got what we call emerging countries, which we would put, Vietnam in, Indonesia, and then at the lower end, maybe Myanmar. From an investment perspective, I think we kind of exclude Laos and Cambodia because we haven't really had any focus there. And then you have a maturing side of Asia, and then Southeast Asia specifically, which would be a country like Malaysia or Thailand. which has a, slightly higher GDP per capita, where, there's still growth in specific sectors. So if you look at these three, so the maturing markets, we're not going to dwell, or the mature markets, let's not dwell on it. It's pretty much a developed market. And if you look at the maturing one, these are markets where not everything is growing. You've got some sectors growing more than others. I would say education and healthcare being the obvious ones. And then in the developing markets, the emerging, markets, like Vietnam or Myanmar, it's, growth is pervasive because the consumers are getting access to the middle class. And, it's less about what sector you choose. Like we said earlier, we were having a private discussion. It's more about the right company in the sectors that are all growing. So if I really try to look at it with a more logical manner, in the emerging side of these countries, it's really about securing the right business, whatever the sector. In the maturing ones, it's finding the right sectors and again backing the right teams and businesses. And finally, in the developing, in the mature one, which is Singapore, I'd argue is finding a good business with a nexus to the other parts of the region.
Thanks, Eric. Okay, so I think it's time to take a pause on the questions I have here on my notepad, but to open up this time to the floor. Does anyone have anything for our panel? No? Maybe in a while? Okay, that's great. So this allows me to ask a really interesting one. Founder family-owned businesses. In Asia and in Southeast Asia, traditionally, founders are not open to private equity funding. Just want to ask from your perspective, have you seen a change in that attitude?
Would you like me to go first? Yeah?
Yeah, sure, why not?
Okay. In fact, the biggest attraction of Southeast Asia and why buyouts work in Southeast Asia is just that aspect. Yeah? Because, let's not forget, 97 the crisis happened in Southeast Asia. It began in Thailand, Indonesia, and then extended on to the Koreas and beyond. So this part of the world developed much before an India or a China. And they were the Asian tigers of the early 90s. I remember when I was in Indonesia in 88 to 93, the stock market just took off at that time. And whatever you threw into the market would take off with multiple times. Yeah. So you have entrepreneurs who had done something before they started off their career, started off their own companies by the late 80s and 90s. And if you just add on the 90s, 2000, another 30 years from then, they are in the 70s, 65 to 75 range, and trying to, what do we do with the business? The children, fortunately, with all the wealth they've made, they want to be investment bankers, private equity specialists. Nobody likes manufacturing, and nobody likes retail and anything so difficult. Consulting is another wonderful area, right? So IT, venture capital, all these things are what real estate. That's the other thing which once you have money in Southeast Asia, people do, right? So all these companies are looking to be, they've done something right, they've survived multiple crises, and the families are, are looking what to do with it. And they are prime targets. We bought over, for example, a hypermarket chain where it was, I think, the third generation working in there, but they were having their differences. And we brought in professionals with a full team of 6, and they've grown the EBITDA about 2.5 times in 3.5 years. Yeah. So they're great opportunities, and the risk. To answer your question very briefly, that's the beauty about this region. Yeah. Whereas in countries like India and China, I would say less mature, more recently developed, the entrepreneurs are too young to do that. That's why you find buyouts more in Korea and Japan.
Josephine?
I'd agree for places like Thailand, where the markets have been open for a lot longer. There are other places where I'm afraid we're at the even earlier stage. So the question is not, would you like some private equity in your business? It's what is private equity? So we've just spent, and I've got a couple of people in the room here, we've just formed the Myanmar Private Equity and Venture Capital Association, and we're educating a market. That's how early stage it is. Not like, would you like a buyout, but what is equity? It's a very, very frontier market, and that conversation about what equity can do and how it can help you grow your business is one which, it's amazing. I remember having the same conversation in the 90s with companies in Hong Kong where they said, what is equity? So we have in Southeast Asia places where very sophisticated people are selling their businesses, and other ones where they're just learning how you can accelerate growth. So I buy into everything that Eric's saying about growth. What we have to try and translate for them is how addition of equity accelerates growth and allows them to compete. And I think that's an opportunity in some of the Southeast Asian countries and in others that have been open to the market. Indonesia, Thailand have been doing it for a long time. It's a different opportunity. But across the sector, I think there's almost everything, every different type of private equity that you can do.
Yeah.
Out of curiosity, Josephine, how long is that runway from the point where you talk to a founder of a business about what exactly is private equity, what's a capital structure, and this is the money you can take to grow your business, to when they finally accept that, yes, I would like to get capital from you?
Sometimes it can be quite quick. The little lights go on. And sometimes it never goes on. They'll always see you as a glorified banker, but more expensive. Some people don't see partnership. Some people do see partnership. For the ones who do see partnership, it's a great discussion. And then, you're part of the family. You're helping them grow their businesses. We've had some very positive experiences there. So I think within frontier markets, because they need so much in terms of governance, access to good financial reporting, the role that equity players can play in these businesses is probably more significant. And that's the sort of in terms of what you bring to a company and the reward you get from helping to develop great companies is more important.
I guess what's interesting from our perspective when we look at whether it's India or Southeast Asia, I think the bigger risk on the growth capital side, buyout's a bit different because you're taking over the company, right? But from a growth capital perspective, especially in less developed markets from a private equity perspective, we're always asking ourselves the question, is the fund manager we're backing doing deals with entrepreneurs that see that fund manager as the lender of last resort, meaning that you're at the bottom of the food chain, and if that entrepreneur is having discussions with you, is it the fact that it hasn't been able to raise capital otherwise through friends and family, through the local banking system, however, exist or not? And I think that is really the main concern here, is that perception. And if I always question that issue when I'm speaking to growth capital focused investors. If you look at India, that's often been the case. Like they had put options at 17%, but they've been exercised, but actually GPs just got their money back. I call that very cheap debt.
And that's a judgment issue when you're talking to the company about whether you can create that relationship or whether you are a cheap form of capital. Bearing in mind that the lending rates in Myanmar, it's 13% for secured, 16% for non-secured.
That is enlightening. Thanks, Josephine.
Thank you.
Okay, so we are almost coming up to the end of our session. I'd just like to ask one more time, does anyone have a question for us?
Active trade friction, US, China, on Southeast Asia.
Well, actually, I think it's the subject of the next
Yeah.
panel that I'm chairing, so.
Yeah.
So that's a nice
very good
segue into the next session. But is there
Yeah, I'd
anything you wanna
love to
add?
comment on
Yeah.
it, because actually on the ground everybody is looking at maybe we can benefit from the Chinese shift out of industry. There's a big competition going on, and if you'll see, Vietnam was current account deficit a few years ago. They're a big surplus right now. Their markets are booming. Indonesia, I think the new government is bending over backwards to attract that capital and make changes and reforms. So all the countries, and one could keep naming a few others, are moving for that shift out of manufacturing locations. But there's also another theme which is operating very powerfully now. We are no longer in a unipolar world, and that's what this whole thing is about. It's not one center of power. And the fact is we have a big gorilla in this region, and it's doing a lot also to, for its strategic interests. So you take something like Myanmar is attracting a lot of Chinese capital in there, and Thailand is attracting a lot of Chinese capital also in there with infrastructure and other things. So there's tremendous activity going on. Just around the Mekong sub-region, if you combine Myanmar, northern Thailand, Vietnam, and the border area of China itself would be around 600 odd million people. So it's bigger than what one can imagine in the press.
Yeah, maybe I could just add, there are certain industries, and we've just done a deal in agri. So there are things that don't link into the global supply chain, but they might link into bigger themes like food and food security. So if you're sitting in an agricultural nation between two countries with food deficits, then you have de-risked a little bit this problem of supply chain.
Thank you. All right. I'd like to thank my panelists for that very interesting, enlightening discussion. And I would like to invite everybody to join me in giving them a big round of applause for sharing their expertise.
Thank you. Thank you.